All right. Well, in the interest of time, we have a lot of terrific information to get through. Welcome, everyone. I am Doris Mold and co-CEO of Annie's Project. And today we have, in plain talk, crop and livestock insurance risk management strategies. We're going to be talking about the fundamentals of federal crop insurance. And we really appreciate the support of the United States Department of Agriculture Risk Management Agency. They've provided a cooperative agreement for this project, and we're thrilled to be part of that. And that is award number RMA 23 CPT 0013617. And as I said, Annie's Project is thrilled to be with you today. Annie's Project started 21 years ago, 22 years ago now. Uh, we've just actually passed another anniversary, and we are so happy to be here. We are here to provide risk management education, and our focus is on women in agriculture, but anyone is welcome to participate in this project. Our founder was Ruth Hambleton, and she currently serves as treasurer of our board. And with me as co-CEO is Carisha Devlin, and I'm going to turn things over to Carisha to get us underway.
Thank you, Doris. It's nice to have everybody here together. Good afternoon. As Doris said, I'm Carisha Devlin, and it's my pleasure to introduce our speakers for today's webinar. Our first speaker is Dr. Hunter Biram. Hunter is an assistant professor in the Department of Ag, Economics, and Agribusiness at the University of Arkansas and associate director of the Southern Risk Management Education Center. He grew up in Floral, Arkansas, working on a diverse family farm operation consisting of a cow-calf herd, broiler chickens, a greenhouse nursery, and a peach orchard. His research and extension program consists of examining regional differences in crop insurance premium rates and optimal producer risk management strategies using federal crop insurance and farm bill programs. Dr. Biram has 33 extension publications on the federal crop insurance program, including his workbook, The Fundamentals of Federal Crop Insurance. I can testify that this is an awesome workbook, and we'll be providing a link for you during the presentation so you can check it out yourself. And I believe Dr. Biram is going to talk a little bit about it, but he's given over 75 presentations on risk management using federal crop insurance, among many other tools. So you're all in for quite a treat hearing from Dr. Biram today. Our second speaker is Dr. Ryan Lowe. And Dr. Lowe is an assistant professor and an extension economist for the University of Arkansas Division of Agriculture. He serves producers by providing education and research on relevant farm financial management topics. And his research interests include ag finance, farm management, supply chain resilience, and value-added marketing channels. And I had the opportunity last year to meet Dr. Lowe at a conference and got to check out some of his research during a poster session. And he is someone else that is extremely knowledgeable. And thank you both so much for being with us today.
Thank you for having us.
Happy to be here. Happy to be here.
So I will go ahead and turn it over to the both of you. And Dr. Biram, I'll let you kick us off.
Thanks. Thanks so much, Carisha and Miss Doris. I'm just so happy to be here and appreciate the invitation to speak with you all today. Talking about the fundamentals of federal crop insurance. And let me go ahead and make sure that I'm sharing the correct screen. What Dr. Loy and I have put together is a three-part program. The first part of the program is going to talk about just general background, the more popular products that are out there for crop insurance, and how to leverage these products in your full risk management plan, even with farm bill programs. As we know, the current ag economy is in not good shape by any stretch of the imagination. It's really important to have a solid risk management plan in place. And so we'll start off with that, and then Dr. Loy will come in and talk about agricultural finance and leveraging insurance and securing a loan. As we know that loan renewals are very stressful are very stressful right now. And then lastly, I'll have a shorter presentation for the third part that I'll just talk about the general forms that are needed and the more practical logistical means in which you would get your crop insurance. So with that, again, just really appreciate being here, excited to be here, and appreciate all the kind words on the work that we've done so far. So first, I'm going to talk about the structure of the crop insurance industry. And so in this, I'm actually going to cover that workbook that Carisha was talking about, the fundamentals of federal crop insurance. Just going to focus on chapter 2 for this part of the presentation. There's a QR code here for that workbook. You can go ahead and follow along at home as I'm going through it. There will be a chapter just devoted to the topics that we cover in this portion, and there'll be another portion where I'll cover other chapters. But if you want to follow along, take notes, please do. There's a lot of information here today. So here's the structure. So we know that agricultural producers, or we can just say farmers, will buy insurance from a local insurance company. So they'll buy crop insurance from a local crop insurance company who then will sell to the agricultural producer. But the local insurance company will contract with what is called an approved insurance provider, or an AIP. So local insurance companies will contract with AIPs to sell insurance to farmers. And the USDA Risk Management Agency, which I see is helping to put on this webinar today, they rate the crop insurance products, or in another word, they price it. They price the crop insurance products that the AIPs will then deliver to the companies. The RMA also administers the Federal Crop Insurance Corporation, which provides the administrative and operating expenses, or the A&O, as well as the premium subsidy and reinsurance to all of the AIPs. So what you're looking at right here is a picture of a public and private partnership. There was a time when RMA fully administered the program and delivered the program just as a standalone, so it was fully public. But actually now it is public and private. So the private companies have now gotten involved in this process. So like I said, USDA RMA administers Federal Crop Insurance Corporation, which provides subsidy to the AIPs. AIPs then provide the products to the companies for them to go out and sell. There are a total of 13 approved insurance providers who provide reinsurance to local insurance companies who sell crop insurance. And here's a link here if you want to see what those listings are. But I'll go ahead and just I think the slide after this, we'll see the list of those AIPs for crop and livestock producers. So AIPs have a choice to take on or pass policies to one another depending on their risk tolerances as a company. The AIPs also provide reinsurance to agencies who will engage in direct sales with producers. So more likely than not, the producer will not engage directly with an AIP. Again, there are only 13 companies that are going to be providing reinsurance and contracting with local companies. So I say here are the cash crop insurance providers. Some of these you may see that are familiar to you, like maybe the Farm Bureau. There's American Farm Bureau Insurance Services. You may have heard of Farmers Mutual Hail. There's Rain and Hail. But also Great American Insurance Group, I know in Arkansas is one group there. Agrisampo writes in Arkansas as well, and so in NAU, and so there's here's just the list of those AIPs. That may not necessarily be the local company that you're going to engage with. I know Farm Credit sells crop insurance, and you don't see them up here. That's because they're working with one of these companies to deliver the insurance and sell it to farmers. And so the same would be for the livestock producers, just making that point clear. Okay, so what we have here is the RMA agent locator. So we'll encourage you to check that out. Just check out the USDA RMA agent locator if you're trying to find a crop insurance agent that is near you. I have an example here of Batesville, Arkansas. That's near my hometown. And so Batesville, Arkansas, you'll see plotted there on the map, and then that's not all the agents, but there on the left there'll be a few agents that pop up, and these are the local insurance companies that are actually going to sell the insurance. What do you notice about the names of the companies? It doesn't say NAU or Country Financial or Rain and Hail. It's just the Gibson Insurance Group. So again, that's going to be that local company that's going to be working with the AIP. Okay, next I'm going to go into the purchase process and important dates such as sales closing and final planting. So here's the crop insurance process, starting with the top left red box, and then we're going to work our way around following the arrows until we get to the bottom left red box. So first, the producer is going to make a choice for the sales closing date, which is coming up for the southern part of the United States. These will vary by state and by crop and largely by region. If there is a prevent plant option that is chosen, what I mean by that is if prevent plant is something that a producer actually wants to use, because it's included in all multi-peril crop insurance products. So like your YP and your RP, it's already embedded in all of those products. But what I'm saying here is there is a final planting date. And so if the farmer says, the ground's just too wet, I couldn't get my beans in, I couldn't get my corn in, just too wet, wasn't able to plant, there is a date in which that cutoff would in which the cutoff would trigger when that prevent plant coverage would go into effect. Now, there is an option to plant and insure a second crop following that prevent plant. So maybe corn, for instance, corn's planted earlier than soybeans. Yes, it is in Arkansas. So if corn is planted first and then there's PP on that corn, but they still want to use the ground, farmer wants to still use the ground, they can still plant beans after the attempts made at corn. And so there's an option to insure the beans that could come after that. Then throughout the growing season, there will be losses that are reported. The farmer is going to work with a crop insurance adjuster who will come onto their farm to verify losses and measure the losses, which will be used for indemnity determination. At harvest, there'll be a final yield that is reported, and the final yield will be what is used to determine indemnities for your yield protection insurance as well as your revenue protection insurance. Now, if you have revenue insurance, the harvest price will be very important here. If you don't, it's not as relevant. So after harvest prices have been determined, indemnities are calculated for the revenue protection policies, which we'll get into more detail about that later. But this is a high-level look at the crop insurance purchase process and some important dates. So what do those dates look like for where you are in your neck of the woods, as Al Roker would say? So you'll see on the left, I have sales closing dates across the U.S. For the South, for the most part, it's February the 28th, although February 15th and 31st sneak in there as well. For Texas, it looks like. But if you look at other parts of the country, you're looking at March the 15th. So if you're looking for more of the Northeast, the upper Midwest, and most of the West has that March 15th sales closing date. But for us, like say in Arkansas, February 28th is going to be our sales closing date. Final planting dates are going to be on the right, and that varies a great deal, as you can see, by county, by region. There's a lot of variation there, but if you're on this call, hopefully you can find your county and you can see what your final planting date would be for corn, for instance. Again, we're just focusing on corn. So you'll see that the final planting dates are somewhat early. So like in Arkansas, for instance, it's either April the 25th or May the 1st. But as you go a little bit further north and look into the upper Midwest, some dates go into June the 5th. And so that just goes to show you the local weather and the local climate of the Southeast region and the upper Midwest, and just how it does get warmer faster here in a growing season. And so that's just reflective in those final planting dates. What about soybeans? So soybeans, we have 3 sales closing dates. Again, look in the Southeast is February the 28th. Most everywhere else is March the 15th. And then there are a few counties there in the southern part of Texas is January the 31st. Final planting dates vary not as much as corn, but they do vary across the U.S. Whereas, in Arkansas, looking at June the 15th. So you can see where from before I was talking about how soybeans can be planted after corn. Well, it does have a later final planting date to allow for that second opportunity to plant. I think looks like the latest final planting date is going to be over in Delaware, parts of Maryland, and that's going to be on July the 5th. But for the most part, you're looking at sometime in mid-June, so June the 15th or June 20th for most parts across the U.S. What about cotton? So anybody that's interested in insuring cotton, you'll see that again, still sticking with most of those sales closing dates, January 31st, February 28th, or March the 15th. In Arkansas, we're looking at February the 28th. The upper parts of Texas and the Panhandle looks like March the 15th. Final planting dates, those are going to be a little bit later than corn for the most part. So you'll see that in Arkansas, we either have May the 25th or May the 20th. But those vary quite a bit along the Cotton Belt region. So hopefully you're able to find your county and know when your final planting date could be. What about for rice? So rice is a big deal in Arkansas. Over half of the nation's long grain rice production is just in that eastern part of the state in Arkansas. So rice is a big deal for us. February the 28th, by and large, is going to be the sales closing date, except for if there's 3 counties in Texas and a few counties up into the Boot Hill of Missouri that'll have different sales closing dates. Final planting date, for the most part, May the 25th. little bit later than corn. But typically I know that our producers are looking at corn and rice kind of in a similar planting window, and thinking about cotton and soybeans in a different in a different planting window. So typically, if there are any prevent plant losses that are triggered, most of it's going to be with rice and corn. Now, with fruits and vegetables. So, what if you're interested in insuring tomatoes or watermelons or a peach orchard, an apple orchard? It could be rye or barley or alfalfa, really just about anything is going to be covered under a whole farm revenue protection policy or a micro farm policy. And so you're looking at a February 28th sales closing date for the Southeast and March 15th. So, similar sales closing dates as what we have already seen with our other row crops. Okay, so I'm going to move into the major products in the federal crop insurance program, being yield protection and revenue protection. My presentation today will not be covering whole farm revenue protection or micro farm, or it will not be covering pasture arrangement and forage, which are other products that are in the workbook. I have been doing a few webinars that cover those products, and so there will be more of those come out. So I'll be sure and share that along with our fabulous Annie's Project team to make sure that folks who want to know more about those particular products, you can sign on to those webinars. But for today, I'm going to focus on yield protection and revenue protection. You may have also heard them called MPCI or multi-peril crop insurance products. So in this part of the presentation, we do have quite a few chapters to cover, but that does not mean that we're going to cover every single detail in these chapters. I put all these chapters up here because I just take a little bit from each one of those chapters and synthesize them in this presentation. So these will be the chapters that I'll be covering today in this section. So again, popular row crop products, looking at yield protection or YP, where the trigger is an APH farm yield or actual production history. Now, the actual production history will be based on literally a farmer's actual production history. So it's all about creating and providing consistent history to show the crop insurance agent, to show the crop insurance company that yes, you have produced this crop for multiple years. This is not your first rodeo, and it gives confidence to the insurer that that you're going to put forth your due diligence to produce the crop, and that there's more trust that's built. Essentially, that's the intuition behind having this history, and it also bases your guarantee. It provides you with a guarantee, and frankly, you want to have your own farm history. You don't want to borrow necessarily the history of your neighbors, because they have a way different production system than you, and maybe you have a different production system than them. And so it's going to have your own farm level history to determine your yield guarantee and your revenue guarantee, but that will be based on the actual production history, APH. There will be a price election made to determine the dollar amount of indemnity or the dollar amount of the loss. Now, I always like to give do a little thought experiment here and ask, why do you think that is? Why do you think that there is a price election made? Because it's yield protection, right? So just yield is being guaranteed. Well, it cause it allows the program or this particular product to be more efficient. So you could think of this as, well, if you're going to guarantee bushels, and let's say we're going to guarantee for a soybean policy, you want to guarantee 50 bushels per acre, but you came in at 40 whenever you reported to your crop insurance agent, you had a 10 bushel per acre loss there, right? So say you got 1,000 acres. Well, that's 10,000 bushels. So one could say, well, the crop insurance company could then bring 10,000 bushels to your farm, dump them on your farm, and say, good luck, go ahead and market these bushels. Kind of sounds silly, doesn't it? So instead, what happens is that 10,000 bushel loss is multiplied by a springtime futures price to convert that into a dollar amount. So instead of receiving the bushels to market at your local elevator or maybe at a crush facility or an ethanol plant, there's a dollar amount that is multiplied by the bushels to give you a check. So as long as that check is net of the producer premium, then yes, you will get a check in the mail, unless you're working with your lender to use that insurance indemnity to help pay your loans, which we'll talk about in that third presentation. But that's why there's a price election in a yield policy. What about revenue protection? RP for short. The trigger is a futures price and again, APH farm yield. So we're looking again at farm level yield guarantees multiplied by a price to guarantee a higher revenue. In this product, I like to say the producer gets to roll the dice on price twice. Lots of ice in there, huh? Producer gets to roll the dice on price twice. What that means is the guarantee gets to be set on the higher of either the spring price or the harvest price. And that's good because it allows you to set the price guarantee to be higher of those two prices, which means you get to guarantee more revenue, and that's a good thing. However, it is more risk protection, so it's more expensive than YP. So that premium is going to be higher for revenue protection than it would be for yield protection because you're getting more price protection. What about revenue protection harvest price exclusion? That'll be the other top product, although there's very little participation in it, but it would be the other one. HPE for short. Also uses futures price and APH farm yield. However, the producer gets to roll the dice on price one time, not twice. So the revenue guarantee is based on the spring price, hence harvest price exclusion. And so it's based on the guarantee is based on the spring price, and then when you get to harvest, there will be a harvest price. So the difference will be taken between those two values. So it'll be your APH expected yield times spring price minus your realized yield times the harvest price. And I'm going to have an example here in just a moment that'll show that there is a big difference between those two products, and you'll see why the RP tends to be more popular than HPE. So let's look at YP first, and I've got a QR code to the chapter on this if you want to follow along at home. So for today, I've chosen Crittenden County, Arkansas. That's probably our #1 soybean county in the state, right there, right next to Memphis, just a few minutes from Memphis, Tennessee. I'm going to choose the 80% coverage level, and we're going to choose our APH, or our actual production history yield, will be 55 bushels per acre. So that means the yield guarantee is 44 bushels an acre. Well, how did I get that? It's the 80% or 0.8 times 55 gives you 44. So currently, actually, the projected price has been determined for the state of Arkansas, and it is at $10.51 a bushel. Not too exciting of a price, but that is the price that we've got. So you take this projected price, multiply it times that yield guarantee, and that'll give you what your revenue would be. And that could be like an expected revenue, but in this particular example, I'm getting ahead of myself. This is a yield example, not revenue. So scratch that last part. The yield guarantee is 44. We actually had 40, so take 44 minus 40, and that'll give you a difference of 4 bushels per acre. Multiply that times the price, and then that'll give you what the indemnity is. And this is what I get for trying to put the cart before the horse. But this is our indemnity. It's about $42 an acre. And how did I find that? 44 minus 40 times the 1051 price. In this case, I did look it up. I looked it up using RMA's cost estimator. The producer premium is about $15 an acre. So if you take the $42 minus the 15, that'll give you your indemnity net of the premium, which is about $27 an acre for this example. So in this example, you would more or less get a check in the mail. It could be a direct deposit, depending on how you have things set up, on a per acre basis of $27 per acre. Now, what about revenue protection? So again, look at Crittenden County soybeans, 80%, APH 55, price 1051. So everything's the same so far as in the previous example, except now we have this revenue guarantee. So you take the 80% times APH times 1051, and that should give you $462.44 per acre in a revenue guarantee. Now, our realized harvest yield was 40 bushels per acre, and the harvest price fell to $9.75. So let's just say the price falls between springtime and harvest, and we lost some bushels. So now our harvest revenue is $390 per acre, which is just taken from 40 times 9.75. So the indemnity then is a difference in revenues. So the 462 minus the 390 gives you about $72 per acre. So this is going to be the indemnity. The premium, again, as I mentioned earlier, is going to be a little bit higher than yield protection, and it is. It's $19 per acre now. So take the difference between these two, and that's going to be your indemnity net of premium of about $53 per acre. So one key difference here is that you're able to see that now you're getting price protection because you got that high guarantee set in the springtime, and that helped you to guarantee more revenue relative to what happened at harvest time. What about HPE? So again, all the same data up to the harvest yield as in the previous example, except now the price goes up. Now, if this was just regular RP, you would be able to set your guarantee on that higher price. That would be nice, but we're not in RP anymore. We're in HPE. So your guarantee is based on that 1051, not on the 1075. So your harvest revenue is the 1051, is the 1075 times the 40 bushels. So realized harvest yield times RMA harvest price gives you RMA harvest revenue. And you'll see that the indemnity is smaller. It's now $32 an acre. I think it was higher than that in the previous example. So subtract the $15 producer premium from $32, and now our indemnity net of premium is $17 per acre. So you can see there's a big difference. We weren't able to capitalize on the price upside that happened at harvest and guaranteeing that revenue with HPE just because of the nature of the program. Okay. Now we'll move into how do you insure land? How do you insure production? So we've talked about the main products that are out there, how they work, the differences in the triggers, differences in the premiums, differences in the prices that are used. Talked about APH, but how do you insure all that? And how do we do that? By field, by county, by multiple fields? How would that work? So to do that, we're actually going to talk about three main unit structures. So if you're talking with your crop insurance agent, they will bring these up: optional units, basic units, and enterprise units. So optional units face the lowest level of aggregation. They allow a producer to insure at the field level and by lease agreement and section. And so what I mean by lowest level of aggregation, I call that my A word. That's a big A word there. What that really means is it's the finest level of protection we can get. And I would almost say the most granular level of protection that we can buy. So we can insure at the field level and by lease agreement and section. Lease agreements are separated in terms of insurability by if you own or if it's a cash rental agreement versus a crop share agreement. So own and cash rental agreements will be lumped into an optional unit, and the crop share will be its own optional unit. So land tenure does play into this. What about basic units? It is one level higher of aggregation than optional units, so it's less granular. And now we're going to start combining ground across sections. So we're going to combine ground by across sections, but you can still separate by lease agreement. With enterprise units, this is the highest level of aggregation. You're going to insure all your fields in one county under one unit, but you have to have at least two separate insurable fields in a given county to use the enterprise unit. That's really important. Okay, so let's look at an example. I'm a visual learner. I like to see things in action, so I'm going to pull up an example of a plat map here just to show how you would break down insuring by optional, basic, enterprise units, starting with optional units. So the question that I pose, which is somewhat rhetorical in this webinar setting, is how many optional units are there? So just take a moment and look at the screen. We've got 1, 2, 3, 4, 5, 6, 7 different farms up here. We've got 4 different sections. So the question becomes, how many optional units are there? The answer is 6. There are 6 optional units. Well, what are they? First, farms A and C will be combined into one optional unit because we're going to combine own and cash rental agreements into one unit. So own cash rent in section 1, farms A and C. The next optional unit will be the 50/50 crop share lease from Smith in section 1. And then the next will be a cash rent from Jones in section 2. And then Farm E, which is a 50/50 crop share from Smith, which is, again, we have a 50/50 crop share from Smith and Farms B and E, but because these are optional units, we can separate those out. The next will be owned. So you might ask, why not lump that owned in with your Farm A? Well, we're in different sections, so we're going to insure by section. And then Farm G is a 60/40 crop share lease from Black. So these are our 6 optional units. You can see that you can separate out your ground largely by these sections and by rental agreements. Now with basic units, how many do you think that there might be here? More or less? Well, since these are more aggregated and not as granular, I would expect less. And there are less basic units. There are 3. What are they? Well, the first will be a combination of all the owned and cash rented land here. So farm A and F are owned, C and D are cash rent, lump all those together and you get one basic unit. Now we're going to combine the different rental agreements. So now we have a crop share from Smith. That becomes its own basic unit. And then the 60/40 from Black becomes its own basic unit as well. So how many enterprise units are there? And it might be a spoiler given there's a big old QR code there. So think about this. Enterprise. What is an enterprise? It could be corn, could be soybeans, could be rice, cotton, wheat. That's an enterprise. So let's assume that we have one crop that we're looking at here, or one enterprise. Well, we're going to combine all of those into one insurable unit. So if this was all corn ground, it would be all in one insurable unit. If this was all soybean ground, it'd be all one insurable unit. So again, enterprise units combine all the ground that you're farming and have, cash rental agreement, crop share agreements, and that you own all together into one unit. And we have a chapter in the workbook on that. And if you scan the QR code, you can follow along there. Okay. Now that we talked about insurability and the differences in units, what about the differences in the subsidy rates? So a note that I want to share here is that farmers will not receive a subsidy. It's not like farmers get a subsidy in their pocket and then they use that subsidy to pay for a premium. That's not at all how it works. Actually, how it works is a farmer is going to pay a cheaper premium than they would have otherwise, because all insurance in the RMA that's administered by RMA and then delivered through these companies is actuarially fair, which means that the premiums and the indemnities will be the same. So the money that you pay in for a premium as a farmer will be the same as the indemnities that you collect over time. But now we're going to include the subsidy. So the subsidy will make that insurance cheaper, so that actually in the long run, it could be, this isn't always the case, but it could be that more indemnities are received than premium. Now that's assuming that the actuarially fair process is correct, of course. But that may be more than you bargained for. But that is why that's how the subsidy works. Now we're going to look at the differences in the subsidy rates by these different units and different products. So with basic and optional units, you'll see that the subsidy rate decreases as you go up in coverage level. Well, why? Because there's a higher chance of triggering an indemnity. There's a higher chance of triggering a loss at those higher coverage levels. So you'll see that we go from 67% at the 50% coverage level to a 38% premium subsidy rate at the 85% coverage level. Again, just for the fact of there's a higher chance of incurring a loss, and so there's a lower subsidy attached to those higher coverage levels. And that's for basic and optional units. What about enterprise? So the enterprise units have a higher subsidy rate. Why is that? Well, it's because we're going to aggregate our yields together across these different units. Whereas before with basic and optional, we were separating out the different pieces of ground, right? Maybe there's some pieces of ground that just aren't as sandy, or you have trouble with drainage on, so there's a higher flood risk. Maybe more clay soil, and you want to separate that out. Well, then you'll go the basic and optional route. But if it's enterprise, you're going to lump that piece of ground into all your other production. And so there's a lower chance of incurring an indemnity and triggering an indemnity, because now you're going to lump in your background, or well, I say background, your less productive ground with your more productive ground, and you're going to put all those together. And so that's why there's a higher subsidy rate faced here. So it is among those three units, enterprise units will face the cheapest premium by and large. What about SCO? We'll talk about that at the end of the presentation, but that's the supplemental coverage option. It has a constant subsidy rate across its coverage levels. ECO has a 51% subsidy at 90% and 44% at 95%, but actually there will be an increase in that subsidy rate. I believe actually both 90 and 95% this year are facing a 65% subsidy rate, which is the same as SCO. So there is an increase in the subsidy rate for ECO this year. Could be of interest to you. What about stacks? That's stacks only for cotton. The stacked income protection faces a constant subsidy rate of 80% from 75 to 90%. And then margin protection also has a decreasing subsidy rate as you increase in coverage level as well. But this point of the slide is to show that there's differences in subsidy across all these products, all the different coverage levels, but they will be constant across all the crops. All the crops face the same subsidy rate. All counties face the same subsidy rate. All states face the same subsidy rate. So what's next? Let's talk about the area crop insurance. So here I'm going to cover chapter 4, and there are parts of chapter 4 that was in the previous material, but chapter 4 highlights the differences that I'm going to talk about here. So here's a QR code for that. We'll talk about the difference in individual and area plans. So the reason that we call it area insurance is that the area insurance guarantees are based on triggers that go beyond your farm. Think of the larger area. So think county yields. So if you know what the ARC program is, agricultural risk coverage, that's an area plan. Grid cell is also considered an area beyond your farm. Those are typically several miles, several squares. They are several square miles. Whereas maybe on your farm, I don't think that you necessarily have a square mile of coverage. So again, think of areas beyond your farm. That's going to be what we think of with area crop insurance. So supplemental coverage option, SCO, area product, has a county guarantee. Enhanced coverage option, ECO, has a county guarantee. Stacked income protection for cotton, area guarantee. Margin protection, area guarantee. So these are all the major area crop insurance products that are out there. Again, they're going to cover the area guarantees, not your farm level guarantees. So if your production tends to not follow what happens in the county, you're going to be subject to what we call basis risk. And so there's going to be differences in what happens on your farm and what happens at the county. But if there's a close relationship between your farm level yield and what happens at the county, these could be some good lower cost-effective alternatives for risk protection. So let's talk about SCO. So it's an area policy that you have to purchase with an underlying MPCI. So say your YP or RP, because it is meant to supplement the underlying MPCI. It has one coverage level of 86%, which provides coverage down to your underlying MPCI. So let's say you have a 75% RP. You could purchase SCO RP and get receive up to 11% of the revenue. So just think about this. 86% down to 75%, and that's your coverage band for SCO. So it's purely a function of whatever your underlying is. If it's 85%, you get 1% of coverage because it goes from 86 to 85. However, you cannot purchase this crop insurance policy if you have the same acres that you plan to enroll in the ARC County program. There's overlapping of coverages there, and so so you cannot get SCO and ARC. If you try to look at the estimator online, it will not let you get an estimate if you have ARC, for instance. Which there are trade-offs to that, and we'll talk about that in just a moment. ECO, enhanced coverage option. It's an area product that must be purchased along with an underlying, just like with SCO, and it's meant to stack on top of SCO with coverage levels of 90 and 95%. And it provides coverages down to 86%. So again, it's intended to enhance the supplemental coverage option. So the supplemental coverage option is supposed to supplement the underlying MPCI, and the enhanced coverage option is meant to enhance the supplemental coverage. Okay, let's look at a picture of what this would be. And here's a QR code that goes straight to this section where this figure is. So all you got to know here is we're looking at the guarantee of revenue or guarantee of yield going from 0% all the way up to 100%. So you'll see there's a little bit of a deductible because ECO does not go to 100%, only goes to 95%. And so ECO would go on top of the SCO, for instance, which would go on top of your underlying 75% coverage with YP, RP, or HPE. So you can see how these are all meant to stack on top of one another, but there still is a 5% deductible remaining at the top of whatever you expect to generate in gross farm income and gross revenue. Now, stacks, again, this is specifically for cotton, and it has coverage levels of 75 to 90%, and it will provide coverage down to an underlying coverage level, just like in the ECO, SCO case. But it can also be purchased as its own standalone product. So if you have 75% RP, you could purchase stacks at 90% and get up to 15% of your expected cotton revenue, which again goes 75 to 90%. There's that 15% band of coverage. However, you cannot stack this with SCO or ECO or ARC or PLC. So when you're all in on stacks, you're all in on stacks. So look at figure 2 on the left first. So figure 2 on the left shows stacks as in joint usage with an underlying MPCI, much like the ECO SCO case. So you see how stacks on top of YPRP, and you can use those together, but there's still a deductible of about 10% on the top. Figure 4 shows why you cannot overlap these overlap stacks with SCO and ECO. And it also shows that there's downside loss exposure with the brown box. There's downside loss exposure from buying standalone stacks because you can only go down to 70% if you buy stacks as a standalone coverage. So there's still some downside potential there. So if you're not at all worried about downside potential for cotton in the county, this is the way to go. But if that's something that you are concerned about and you want to get RP on your stacks, you can do that as well. Okay, this is going to be the last section of the presentation. As I'm wrapping up here, we're going to talk about the jointness of federal crop insurance and farm bill programs, because we know there's some big deadlines coming up with your FSA programs as well as crop insurance. So there are a few ways you can go. The first is you can just get PLC if you want to, and get that price loss coverage. You can just get agriculture risk coverage or just get that ARC if you want to. Strategy 3 is you can get RP and PLC, and I'm going to focus on the revenue case for right now, just as an example. You could throw RP in there, you could throw YP in there, or HPE, but we're just going to focus on RP for the moment. You can get RP and ARC and get those two together, which I will say could be a good way to go. And I'll talk about what the best strategy is here in a moment, but just remember this. RP, SCO, ECO all use futures prices for guarantees. RP uses an APH farm yield. SCO, ECO uses an RMA county yield. And then ARC uses a county yield from FSA and a marketing year average price, which is a cash price. So different sources of risk are being covered with these programs. PLC, the protection is based on a cash price, and there's a farm level PLC payment yield. So there are different sources of risk. You're not necessarily overlapping them perfectly. There are different sources of risk being managed, but I think it's worth noting here. Now you can go RPSCO and tack on PLC. You can go RPSCO ECO and tack on PLC. You can go RP, ECO, and ARC if you want to. So if you want to go with ARC and you think that the guarantees are more favorable, you can go with ARC. So I would recommend taking a picture of this slide just to show you your different options. I'm going to provide my recommendation in the next couple of slides and explain why that's my recommendation. And that's going to be based on just an example county from Arkansas. I'm saying in this case, strategy number 7 is the best. Last year, whenever I gave this talk, I actually said number 6 was the better way to go, which was when you stacked all the programs together and did PLC. But now I'm saying maybe forego SCO potentially this year, and I'm going to tell you why. So strategy 6, remember, is when you bundle all 4 of those together, your RP premium is $19 an acre, SCO is $3, and ECO is $9 for a total premium of $31 per acre. Now, strategy 7, you don't have to pay the $3 for the SCO, and you may think $3 is trivial, and maybe you want to go that way. And I'm not saying don't do it, but I am saying just consider this alternative. Your total premium under this scenario is $28 an acre. Underlying both of these approaches is some optimal RP crop insurance coverage level, which varies by county. But we're going to choose 80%. We're going to stick in the 80% range, which is like our examples from before. So this is just using ECO and not including SCO. You'll see that there's price downside risk exposure until you get to 95%, but you also see that there's a gap in coverage. Much like those who watch a lot of college sports, there's the Aflac commercial with Nick Saban and Deion Sanders, and there's Aflac talking about the gaps in coverage. Well, there's gaps in coverage here under this scenario, but it may not be something that you should worry about depending on your risk preferences and risk tolerances. Now, I will say, before I even get into the FSA part, the reason that you would not be as concerned is maybe you just don't get a lot of loss on your farm. Maybe there's only shallow losses, and maybe at the county level, because shallow losses could be more likely than deep losses, maybe you just want to stick to the RP80 and you don't need to spend extra on the SCO, and maybe you're only concerned about this moderate, slight downside risk protection from price or from production. I know in Arkansas, I hear a lot of rice farmers say that because they irrigate everything, they're not as concerned about yield risk, so ECO is a great alternative for them. Now, I will say, let's think about ARC. So I've actually put on here the ARC coverage band, which is actually 76% to 86% of FSA county revenue. It's the percentage of FSA revenue, not RMA. So the FSA revenue guarantees actually in this particular year, this is not the same every year, but in this year, they are higher than the USDA RMA guarantees. As you can see, we have 584 instead of 549. So let's look at these revenues. So the ARC County revenue guarantee is set at 584.22 per acre, and that's listed on our graph here. The RMA expected revenue is 578 505. Is that right? Hold on. Actually, the RMA expected revenue is 578.05. 80% of the RMA expected revenue is 462.44, which you'll see on the left-hand side of the chart there. 86% of that revenue is 479.12, and 95% of that's 549.15. So that's where those numbers come from. Those are the different coverage levels that we're looking at here. Now think about this, and this is where I'll end. 80% of RMA expected revenue, again, 462.44, with a total premium of $31 an acre under the Strategy 6, right? With a difference of 431.44. Now the ARC guarantee, and you don't have to pay for ARC, is 584.22 in the Crittenden County example. So it will vary by county. This is for Crittenden County, Arkansas. It will vary by county. But in this example, the ARC guarantee by and large surpasses that of the difference between what your RMA guarantee would be under Strategy 6 and the premium. So the key here, the differences between FSA and RMA guarantees matter. They do matter in this case, but no one is better than the other. Remember, they manage different sources of risk. FSA with the cash prices, RMA with the futures prices, FSA with the Olympic average county yields, RMA with RMA yields and APH yields. So they manage different sources of risk, and you should use them jointly, but there are big differences between the two. And so with that, that's the end of my presentation. I appreciate your attention and appreciate your time greatly. And so with that, perhaps I should wait a minute maybe for questions. And one idea that I had, and Carisha and Ms. Doris, if you want to veto me on this, you can, but maybe it could be a good time to maybe take like a 5-minute break before we get into Dr. Loy's presentation. And because he's got another batch of information that he'll bring on, and then I'll have that second presentation after his, and then we'll call this a webinar. What do you ladies think?
I think that's an excellent idea. That may give people a few minutes to kind of ruminate on some questions.
Yep, absolutely. Yep. So maybe 12:50 we'll crank up with Ryan's, but in the meantime, I will be here. I'm happy to answer any questions. If there's any in the Q&A, happy to answer those to the best of my ability. And if not, I totally am grateful for this opportunity. I appreciate the opportunity to be here, present the information, and I know there's a lot of information. I will drop my email to everyone. If you have any follow-up questions. And I'll take this moment to promote these QR codes here. We do have a U of A and AgriCon Extension newsletter where we talk about topics like crop insurance, but we also talk about the markets and talk about interest rates, as Dr. Loy that's his area, and talk about farm management practices and risk management. And then we also have a podcast, and this is a weekly newsletter and a weekly podcast. So would encourage you all to sign up for that as well. So appreciate the time. Again, just super humbled and happy to be here.
We do have a question that just popped up. The question is, will I expect my insurance agent to help me with these kinds of strategies, or will I have to look for additional help?
Yeah, Miss Ruth, that's a fantastic question. I would say it depends. Not all crop insurance agents are made equal. There are some fantastic ones out there, and I know them personally, and they will do whatever they can to help you to manage the most risk. So some will understand ARC and PLC and how you can use it or cannot use it. But there are some that aren't as aware. Maybe they haven't had the time to look into it as deeply. And so it just depends on your crop insurance agent. I will say that is one thing that comes up in conversations that I have with farmers here in Arkansas is, if all the prices are the same, then how do they compete? How do these insurance companies compete? It's on service. They mostly compete on service. And what plays into service is knowing the ins and outs of farm bill programs, knowing the ins and outs of the crop insurance programs, and just knowing the production region that they are trying to market in, knowing the soil types, the local climate, knowing production practices, the differences in irrigation. Do you irrigate or not? Do you use center pivots? Do you use furrow irrigation? So knowing all of those things, crop insurance companies and agents compete on service. And so, yes, I hate to give you the economist answer if it depends, but it really does. I am of the type that I like to do my own homework and do my own research most all the time, but there are some agents out there that'll just come out and maybe even teach you something, and they may teach me something that I didn't even know. But there are some good ones that are out there.
Before we jump into our next presentation, I just want to express gratitude to Dr. Biram for his time and all of the great information that he shared with us today. And I really encourage any of you who are listening that if you do have a question or something that you think of, even if it's later on today, take advantage of his sharing his email address. So, if you do have a question, he is a great one to email and ask. So now, Dr. Loyal, I'll turn it over to you to talk about financial risk management using crop insurance.
Well, thank you everyone for donating your time today. I know you probably have very busy schedules, and look forward to kind of covering this topic with you. So today I'm just going to be talking about how you can really use crop insurance, and how it relates to the finance side of the business, and how it can really be a helpful risk management tool and safety net to help you when you're, trying to secure operating notes or pay back operating notes. And we're going to look at an example of that today. So as I'm going through, I'm going to be covering Chapter 8 from the Fundamentals of Federal Crop Insurance Workbook. And as you go through this, if you follow along, it's kind of just what the presentation will be like today. We've updated a few things since writing this chapter, but I'll highlight those updates as I go through the presentation. So you can scan that QR code. It'll take you to our workbook. And again, I'm just covering Chapter 8 in this presentation today. So a little brief roadmap here. I'm going to start by giving a history of, why ag finance is even a topic in agricultural economics, and why crop insurance has become, a big talking point, and why farmers, have looked to using it more and more recently. Going to talk about the Schedule F, which I know Dr. Biram kind of alluded to before, and some tax implications of crop insurance. Going to look at some practical examples of reporting the crop insurance proceeds or indemnities and premiums on your Schedule F. And then we're going to quickly talk about crop insurance and debt obligations. And I'll finish it up by talking about a online web app that I have and currently in development, and just kind of go through that and how to use it. So if you have any questions at any time, I'm happy to take them. You can interrupt me, or I'm happy to take them at the end. So just to kind of kick this off here, again, I wanted to just give a brief history as to why we are, looking at, ag finance in this space. And so I'm going to give it from two different perspectives. The first perspective I'm going to give is pre-1980, and it could be about, pre-1979, 80, somewhere around there. Now, what we had during this time was what they call an agricultural bubble. And it's very similar, and what happened was very similar to what happened during the 2008 financial crisis. What we saw in that period, that decade leading up to 1980, was a lot of investment in agriculture. We had a lot of folks had savings accounts or, saved money, and decided to take that saved money, whether they were investors, private, just the general public, or farmers themselves, and investing in the agricultural sector because it was a stable investment with good returns, right? So people, took some of their money and invested in that. And what we saw from that was a sharp increase in debt levels in the agricultural sector, followed by a sharp increase in land values, right? So people were investing in that land, and they were able to take out, take out money and invest into that and generate good returns off of it, or at least that was the idea behind it. Additionally, and kind of helping push this up was the income tax deduction. So during this time, used to be able to actually deduct your interest expenses for that year on your taxes. And so what that ended up doing was, two things. Basically meant that if you did take out a loan to invest, you're paying a lower effective interest rate. And it just kind of promoted high debt levels. So if you take out a high debt, well, I can write it off that interest expense, right? So it kind of promoted and created an environment for folks to invest in that area. And so, during this time, we saw the price of corn increase dramatically, farmland values rise by, 88% during that times. And so in other words, the potential for high returns in a stable sector attracted a lot of investors during this time. And so then we have the period of 1980 to about 1986, which is that agricultural financial crisis. And I'm sure that if you're in this audience, you probably heard of it at least. But what happened was the most extreme financial crisis in agriculture, at least since the Great Depression. And over here onto the right, this figure that I'm showing you is two things. I'm plotting this blue line, which is the federal funds rate, and I'm plotting this red line, which is the personal consumption expenditures index. Now, when you hear on the news, interest rates are staying the same or the Federal Reserve is deciding to change interest rates, they're talking about this blue line, and it's called the Fed funds rate. And essentially what it is just the bank-to-bank interest rate. So banks charge each other an interest rate to borrow money, and then that motivates the prime rate, and the prime rate's going to determine what you'll pay on short-term debt, operating notes, for example, in this case. Now, what you can see here is that we had a sharp increase in that interest during that time, that interest rate. But what happened is as you can see, this red line, the Federal Reserve at that time saw inflation starting to creep up. Expenditures are high up and they're starting to kind of run away. And so the way to do that is to raise that interest rate to slow down the economy, spur investment and ensure that we don't have the supply growing of our money, and that's going to impact our purchasing value, right? Our purchasing power of the money. And so what ended up happening is we raised those rates. As soon as the Federal Reserve at that time saw inflation start to tick down, they decreased those interest rates, and that threw us into two back-to-back recessions pretty quickly during that 86 timeframe. Now, the current Federal Reserve chair is very aware, and he's come out and said he's very aware of what happened in the 80s and the decisions that were made back then. And so while we're in a very frustrating part of the farm economy right now for, debt and operating notes and everything in between, lending in general, they're very aware of what happened. And so while it's frustrating, the reason that the Federal Reserve is being slow and kind of taking their time cutting rates this time is because of exactly what happened in the 80s. So three key factors really contributed to this was that 1979 monetary policy I just talked about, the strong US dollar, which a strong US dollar comes with raising interest rates, right? So think about it very simply on supply and demand. If they raise those interest rates, they're trying to pull back in the supply of US dollars on the marketplace. And by pulling that back in the supply, the value is going to raise for it, right? That purchasing power. And it's great to have a strong US dollar if we're vacationing in a foreign country, right? We can get a lot for a lot less. However, if you turn that on its head and you're in a foreign country trying to purchase US economies, you purchase US commodities, it gets very difficult. And so that demand is going to start kind of going away, and it's going to be shifted off to other countries, which is what we see actually right now with Brazil, for example. And then the 1980 Soviet export ban. If we don't have a market to deliver our goods, then there's less values placed on it. So we had a lot of people investing, and the bottom absolutely fell out of the agricultural economy at the time. Just bottom fell out. Farmland values declined, commodity prices absolutely declined. Farm closures happened, bank foreclosures, and everything that can happen during a big recession happened during that time and was most predominant in the agriculture sector. So fallout from that, all that craziness I just talked about, and the uncertainty in the markets and the, no profitability and having to close up shop really kind of started the motivation for an interest in crop insurance. There was a greater demand after this for farm support in the face of an economic downturn or in the case of catastrophic losses, right? Moving off of that production-based protection and looking at it from a revenue standpoint and looking at it, okay, I need guaranteeing myself a level of revenue in case, everything just kind of goes backwards on me. So these policies, they aim to stabilize farm revenue, right? That's kind of their main goal, no matter what policy, crop insurance policy it is. That's the idea behind it. And then to provide more risk management tools to producers, right? To diversify their risk management, right? Don't want to put all your eggs in one basket. And one of the most popular insurance products emerge as revenue protection policies. So those allow a producer to guarantee a designated level of revenue protection against that falling commodity price, right? So just as I mentioned during the ag finance crisis, those commodity prices just absolutely plummeted. And so this allows the producer to kind of protect against that. And it allows them to better equip themselves to cover those farm debt obligations since they're guaranteed to receive a portion of their expected revenue. So this is kind of the framework that we're going to be working in today. And before I really get down into it, I want to stop and just kind of look at the Schedule F, talk about some tax things, because I get a lot of questions on that. And it's honestly very simple when it comes to crop insurance, which is pretty nice and usually not the case when it comes to taxes. So first, we're just going to talk about what is the Schedule F. Well, the Schedule F is known as the Profit and Loss from Farming form. It's the Form 1040. And so if you're a farmer and you have an agricultural enterprise, you're most likely using a Schedule F. And so it's an IRS form, and its whole purpose is just to report net profit or losses from your agricultural production. Okay, so when we're pulling and we're looking at, what we made last year, we're going to pull that from the Schedule F, right? So it's going to take into account all of our expenses and all of our income areas. So let's have a quick look. I want to just kind of go through it. The discussion here is really not going to focus on the intricacies of filling out a Schedule F, for every single thing, but I'm going to focus on how crop insurance premiums and indemnities are reported on the Schedule F. So that's the main focus here. So I just like to go through it first. So right at the top of the Schedule F, you're going to have basically all of your identifying information on there that you would give to the IRS or give to your tax preparer. Then we're going to have Part 1, which is farm income for the cash method, which is what we're going to be focusing on today. You have a choice of, as you can see in that box up there, accounting method, cash or accrual. Cash method is going to be you record it whenever the cash changes hands, when you receive that cash or you pay the cash out. And then accrual on the other side is going to include things like accounts payable, accounts receivable, where things you expect to pay or things you expect to receive may not have been received yet, but we're going to record it anyway. But for this presentation, we're just focusing on the cash method for income. So this is going to be that cash method on the farm income, and we're really going to be paying attention to this line 6 down here, crop insurance proceeds and federal crop insurance disaster payments. Going through a little bit more, Part 2 is going to be your farm expenses, which is cash and accrual method combined. So if you prepaid your expenses or you plan to prepay or you haven't paid the expenses yet, but you will in this year, then you're going to record it here regardless. And so what we're going to be paying attention to here is going to be this line 20, insurance other than health. And just for the sake of completeness, the Schedule F also has a farm income on the accrual method side, which you are also welcome to use if that's what you prefer, or if that's what your tax preparer prefers. But we won't look at it here. I just wanted to present it to say, hey, there is also a part for accrual methods for farm income. So tax implications of crop insurance. So it is included on the Schedule F as that farm income, as I alluded to earlier. And it's included as farm income because it's essentially, though, that indemnity that you're getting, which is indemnity is that mailbox money, the money you're receiving from the crop insurance provider. It's basically taking the place of your crop revenue, right? So it's going to be recorded just the same way as farm income for crops or livestock. If you do receive, or if you do participate in crop insurance, you're going to receive at the end of the year a 1099 miscellaneous form, which is going to have your premiums and your indemnity amount on it. And you will include that to the Schedule F as well. But what's really important about crop insurance is that you can report it in a different way. And the important part of understanding of how you can report it is to say, well, I need to make sure that I have that my matching principle is there, and that if I was typically going to get that income this year, that it's recorded this year, versus if I sold my commodities, after the year of production, that it's recorded that year. And we'll get into that in just a minute. So again, we're paying attention to this line 6 here, just from that part 1 farm income cash method part on the Schedule F. So you have two options basically when it comes to crop insurance. You can not defer them and pay the tax on that income this year, and you do have to pay a tax on it because it is, one, it's a government payment, so you do pay taxes on government payments, and two, even if it wasn't, it's taking place of that crop revenue that you would have been getting anyway, and you pay taxes on that as well. So either way, you will pay tax on it. Let's look at the first way, not deferring it. So this producer decides that I'm going to pay taxes on this crop insurance indemnity this year. And so let's say for this example, the producer is awarded $50,000 in that indemnity. However, they always sell their crop the same year as production. So historically, they produce it, and in that same year, they've sold their crop. So how would they report that? Well, they're going to come to 6. They're going to go to 6A and say amount received in 2022. And I pulled the Schedule F off the IRS's website, but if you're doing this for this year, that would say amount received in 2024. Okay, so you got 2024 here, and recorded it in 6A because you did receive that amount this year for $50,000. However, or because you sell it the same year as production, typically, you would also be paying taxes on that crop revenue in this year. So because of that, you're going to record that $50,000 on 6B, and now it's going to be taken into account as part of your taxable income. But what about if you want to defer it? Now, deferring the income doesn't mean you get to avoid the tax burden. It just means you're going to push that tax burden to a different time. And when we're looking at this from this perspective, I can't just decide now I want to defer it when I haven't ever historically sold crops. If I've never historically sold crops in the same year as production, I can't just decide I'm going to start deferring these payments. This income can only be deferred if and only if the insured crop or crops are typically sold the year after production. So in order to do this, you would have to attach to your Schedule F a statement saying I am deferring this, and here's why, and here's some records, here's some historical records of when I've sold my crop. And usually it's not a huge deal, but you do have to have some sort of supporting material to actually do that, and that the IRS be okay with it. So historically, they've always sold the year after production. So even if they didn't get a crop, even if their crop was still good and they actually did get to harvest their crop, they wouldn't have that income recorded on this year anyway. So they're not going to do it for their crop insurance proceeds. So in this case, they're going to record that $50,000 right there on that 6A again, because you are still receiving it this year. However, now you're going to check this box and elect to defer it next year. Okay. So now assuming you defer it to next year and you have those attachments to the Schedule F that I mentioned, then that next year's Schedule F is going to include this $50,000, except you're going to include it here on the 6D for next year, because this is that amount deferred from the previous year. And so your Schedule F should line up. It should be kind of like a game of leapfrog. Like I'm taking this, I'm deferring it. Now it's going to be on next year's. And if I have one next year, I'm going to defer it, just kind of keep moving that on. So that's the idea here. It's really not too difficult. It's pretty straightforward, just making sure that you have that supporting material to say, I can defer it. Okay, what about the premiums? Again, this is very straightforward as well, thankfully. So let's assume that they paid $40,000 for those premiums. They're going to locate Schedule F, Part 2, line 20. Okay, so we've pulled this up here, and we're going to look at line 20, insurance other than health, and we're going to report that $40,000 there. Now, premiums, that's the one thing that Dr. Hunter Byram and I get a lot, is, those premiums are expensive. I don't want to pay the premiums. And that is not incorrect. Premiums can be expensive. They can get high depending on your location, what you're trying to cover, and all those good things, just like Dr. Byram's presentation that he just gave. However, you can deduct this expense off of your income. So that's an important part is that, yeah, while it's expensive, you can use this as a tax deduction, right? An income tax deduction, because you're going to remove this from your taxable income, and it could help with that tax burden pretty significantly. And that's kind of the important part here of using the Schedule F. If you're a farmer, using the Schedule F is most often the most beneficial thing to do because it contains these expenses that you can deduct, whereas other forms may not, such as the Schedule C. It doesn't have all of these expenses to deduct off on there. Okay, now let's get into the real meat and potatoes of this presentation and talk about, how crop insurance works with debt obligations and how you can really use crop insurance to help be that financial risk management tool. So one of the things I'll talk about here at the end is what's the safety net. It's called the safety net tool, and it's a web app that I'm working on, and it's still in development. It probably always will be, and that's the beauty of working on these things, is that there's always something to update or to change. But it's live and it can be used right now. And so, I just wanted to present it here early as we go through this example so you can kind of see, the reason why and the question we're trying to answer as we go through this. So one of the things that Dr. Biram and I see is we see a lot of increasing crop insurance adoption in the South. Historically, the South has not, adopted crop insurance at the same levels as, maybe Midwestern farmers have at the time. But, whether it's from economic downturns, low commodity prices, or just the variable weather we've had down in the South, we've really seen crop insurance become more and more kind of mainstream in a way. More people are using it, more people are asking questions. So because of that, we're starting to see lenders are requiring some level of coverage, right? Lenders may often, they say, well, I want some level of crop insurance coverage because that's going to have some underlying support in case of some loss that I'll be paid back from the lender's perspective, right? However, even though they require some level of coverage, they don't discern between coverage levels and types. Some lenders I have seen do, but if I can make a generalization overall, most don't discern between coverage levels and types. And so, if you took a 50% RP policy, that's the same as having an 85% RP policy, to help secure that loan. But as Dr. Byram kind of showed, there's a lot of differences in that liability amount between those revenue protection levels. So the tool that we developed, really the whole point is to just provide peace of mind to both the producer and the lender. So the idea being is that both can sit there, together and use the tool, and they can have better informed decision making in the event that that farmer faces a catastrophic loss on his crop this year. Now, for our example that I'm going through today, I'm assuming a catastrophic loss, but it doesn't necessarily have to be, and I'll get to that in a little bit. So what is the question then? I've said a lot of words, but what is the actual question? Well, the question is, what is the minimum crop insurance coverage a producer should take to guarantee covering operating debt obligations? So really simplistically put, all that this tool is doing is weighing your guaranteed revenue relative to the operating debt you hold and the premium expenses, and just trying to see at what point does that guarantee pay off both of those things in the event of a catastrophic loss. So again, can crop insurance cover an operating loan? So in this case, we're going to be looking at using revenue protection policies to guarantee some level of a debt obligation. Okay, so let's set the stage here real quick. We've got a representative farm. Now these numbers are made up kind of besides the USDA RMA number, which would be lovely to see now. I'm just using last year's premium estimates and USDA RMA's projected price from last year for this purpose. But these are just kind of a representative farm. The APH yield on their soybean is going to be 50 bushels an acre. Their projected price per bushel is from the USDA RMA's $11.84. and the number of acres they planted is 324. That seems like an oddly specific farm size. And all I did was just go and look up from the Census of Agriculture what the average farm size was in Arkansas, just to kind of have a representative farm. Now, I recognize that a lot are much bigger than that, and some are much smaller than that. But it was just to say, we'll use the average from the census. So their expected revenue is about 192,000, right around there. So based on what their APH yield was, which is their actual production history. So they have forms, they have historical records that say, I'm expecting 50 bushels an acre. The RMA projected price is 1184, and I plant 324 acres. So given those three things, I expect my revenue to be about 192,000 this year. Well, on the pre-harvest expenses side, on the operating side, summing all of those pre-harvest expenses up brings us to about $104,629 over the whole farm for getting a crop in the ground this year. So for this case and for this example, let's just assume that it's a $105,000 operating loan that this farm must needs in order to put a crop in the ground this year. So how are we calculating these revenue guarantees? So on the revenue protection side, you can guarantee a range up to 50 to 85% of your total expected revenue, and that's 5% increments in between, so 50, 55, 60, 65, all the way up to 85. And so for this person, what does their range kind of look like? Based on this expected revenue, they, at 50%, they're covering about 96,000. At that 85%, they're covering about 163,000. So that's the range they have for that revenue guarantee based on the farm's demographics I was presenting on the last slide and how revenue protection, policies work. So let's take a quick detour and just talk about the premiums associated with revenue protection. And I just wanted to talk to you about my assumptions that I've made here. So I'm assuming that they're in Arkansas County, which is Arkansas County, Arkansas, and we do have an Arkansas County. Is out there, if anybody's familiar where Stuttgart is at, it's going to be out there in Arkansas County. There going to be optional units, irrigated soybeans, 50 bushels an acre, and that projected price of 1184, and a 324 acre farm. Based on those demographics, this is the RP premiums they should expect to pay. Now, as you can see that the premiums increase as that coverage level also increases as well, right? It makes more sense. You have a higher liability, they're going to have to charge you more, right? And so you can look at the per acre premium and then that total premium over all of the acres in this situation. So premiums are expensive. However, it's one of the things I hear Dr. Biram say, if we're looking at insurance, think of it to some degree, if it's helpful, as another input. An input like fertilizer, an input like labor, right? Think of it as another input to your farm. Because again, you don't necessarily want this stuff to pay, and paying $11,000 in premiums over your whole farm is tough to do. I mean, it's difficult to convince myself of doing that too. However, you just know at the back of your mind that, hey, I just guaranteed myself to farm at least one more year. And that's the whole goal, right? So at the very least, what you can say is that I have peace of mind that I have bought myself a chance to farm another year. So I just wanted to kind of show this real quick. And again, this is something that Dr. Biram has helped me put together for the tool. Just calculating RMA premiums, which is difficult to do. And so our RMA does have a cost estimator, but our premium estimator on the tool that I'll show later is a lot faster, just because we've kind of already done the calculations in the background. And so if you're the users of the tool, there's very little wait times. And so what we basically did was sacrifice the wait time for accuracy to some degree. And I just kind of wanted to show, if you're using RMA's official cost estimator versus ours, where are the differences? And, the most difference we see is about $1 on that higher end. But most of all, we're pretty in line with what their estimations are. So again, all these numbers are an estimate. Your farm could look much different. So let's talk quickly about how are these returns calculated and how do they work? So I have to make some assumptions here. And I'm assuming that the producer in this case is going to pay that operating loan in one lump sum at the very end of production, at the very end of harvest, excuse me. So they're going to pay it at the end of harvest. And for this case, I'm assuming that is going to be 9 months. So let's look at this example. We're going to look at an example, 324 acre farm, 50% RP under a $105,000 operating loan. So what we'll do is we're going to take this revenue guarantee. We're going to start there and figure out what the revenue guarantee is. So based on that farm's expected revenue times 50%, about that 95,904, that's that revenue guarantee. Okay. Then we're going to figure out what our total operating debt obligation is. So the total payoff at 5% interest over 9 months is going to be 109,000, about 109,000 and some change based on the $105,000 operating loan. And the tool does this for you, so don't worry about having to amortize your loans when you're doing this. 50% RP premium for Arkansas County, 50 bushels an acre irrigated soybeans, and everything else I presented is $379 an acre. Over 324 acres is going to be about $1,228 in total. So what are we trying to do here? We're going to take that revenue guarantee minus that operating loan obligation minus that producer premium and see where we end up. So in this case, at 50%, at that $105,000 at 5% interest, with that RP premium, it looks like in the case of a catastrophic loss, and I wanted to kind of remind that this is in the case of a catastrophic loss, you're assuming that all of the liability you got covered for paid out, okay, in this case. So based on this case, in a complete and total catastrophic loss scenario, this farmer is still on the hook $14,000 between their premiums and their operating loan debt. So they have to go find or restructure debt or take out more. And like I said, restructure debt in order to pay this off and continue to farm one more year. But let's look at this on a whole range of revenue protection coverage levels and interest rates. Now, from the beginning, this may be a lot of numbers and it's crazy. And some of these numbers may be even big, but I'm going to just quickly kind of dissect this for a second. So as you can see in this corner right here, we have that 14,327. And if you quickly show just real quick, that's that 14,000 right here. So each cell is doing this calculation. Okay, so right here. And so quickly, when I show this to people, one of the things I say is to immediately look where it goes from red to black, because that is the moment, kind of that break even interest rate and coverage level. And so in this case, we're looking at about 9.5% interest at that 60% coverage level will get you in the positives. And that's pretty good. And so essentially, if a lender and a producer are looking at this table, how I would, how to use it would say, okay, well, 50 and 55% seem to not be giving me sufficient coverage for my operation. So in the case of a catastrophic loss, I'm still going to owe money. However, the 60% seems like a good minimum coverage level to take, but it could be sensitive to that interest rate. So again, a lot of these are estimates. So when you put in your real numbers, it may be the case that, these ones that are barely positive, those could go negative based on your own assumptions. So you can say, well, 60% we can tell is pretty sensitive to that interest rate. But 65 and above seems to be a pretty good option. So if I was, the producer looking at this and say, I think 65% is going to be 65% RP coverages, will get me to a point where, look, I've got that peace of mind. I can pay you back, pay the lender back if I lost everything. And so that's kind of that minimum that I should consider taking. And from the lender's perspective, they can have a more informed decision when they're looking at what coverages, other farmers have and kind of understand what that looks like as far as debt obligations are concerned. And one of the other things I like to say is that I know that if you look at, this 85% coverage and you're looking at values of $43,000 up there, I always say it's not a get rich quick scheme. It's not the point of insurance. But what the point here is to say, yeah, you do have $42,000 net of everything else. However, that is going to be used for family living expenses and other longer term debts that maybe you had a debt servicing payment upcoming that with your loss in crop value you can't cover. And so, those sorts of things can help in that scenario. Okay, real quickly, I know I'm kind of running out of time here. I just want to kind of go through what the safety net tool looks like. And there's a QR code on here. And if I go too quickly and you're not able to scan the QR code, I can provide you with it, and you can go mess with it and play with it as much as you want. So this is going to be the safety net tool. It's all web-based. You can use it from your phone, but it's better on the desktop, and it's all free as well. And again, this is something that is just a work in progress, and it probably be a constant work in progress. But this is the first view, and as you can see, the table looks very similar to what I presented here. It's because it's exact same table, and it works the exact same way, except you're able to kind of input your own user inputs. Right now, it's only Arkansas. You can select your county, your crop, irrigation practice, your crop insurance program, which right now it only contains revenue protection, harvest price exclusion, and yield protection. Select your insurable unit insurable unit structure, and acres planted. Then you're going to provide your expected yield per acre, projected price, estimated operating expenses on a per acre basis. And once you do that, put in your estimating operating expenses per acre and providing your loan terms and the number of acres you planted, the tool is going to take that operating expense, multiply it per acre, say that's your principal amount essentially, and it's going to amortize that principal amount over whatever loan term that you put in. Okay, so this is what it looks like. Again, it's going to give you a first cell breakdown of what's going on. So 55% APR, 50% coverage, that revenue guarantee. And in this case, you don't have to assume a catastrophic loss on the tool. There's a little slider bar right here that multiplies that damage adjustment factor by the revenue guarantee. So, what's often 100% loss to me as the farmer is not 100% loss to the adjuster sometimes. We could be coming at it from different angles. And so this goes in and allows you to adjust that to say, okay, well, what if I only lost 20%? Or excuse me, what if I only lost 80%, right? Or what if I only lost 20%? How does this table look like under those assumptions? Again, the second tab on the tool provides you with producer premiums. So it just breaks down the producer premiums of what you've chosen and everything, breaks down those coverage levels. And so you kind of know per acre what you expect to pay. And lastly, a loan amortization tab. I did this mainly because I try to move most of what I do off of Excel if I can. And I was tired of looking at ads when I would, point people to some online versions of this. But this is ad free and it's easy to use. So you can go in there and put your principal, your loan terms, your interest rate. I only have monthly and one payment on there right now, but I'm gonna, include quarterly payments, those sorts of things as needed. So, and you can, copy it to Excel, put it to Excel, or put it to a PDF. So looking into the future real quick, I just want to include more states into this. Right now it only has Arkansas. I'd like to provide more coverage options eventually, ARC, PLC, whole farm, micro farm, and PRF as well. And then include an option for family living expenses and long-term debt, and looking at this analysis while also covering those two pieces of debt as well. And then finally allow for a direct input of principal. I want to tie that loan amortization tab to the first tab. And so that way, if somebody can go in there and input that principal, and it would be included onto that tool as well. But that is all I have today. I want to thank everyone so much for their time. And if you have any questions, if I spoke too fast, or if you just want to chat about this, I'd be happy to anytime. I'll put my email in the chat, and I'm happy to share these slides if anybody needs them. Thank you so much.
Well, it looks like you have a lot of fans on the tool here, and they want to see it everywhere. So you've got some hours ahead of you, Ryan.
Looks like it. Well, thank you all so much for the feedback. I really appreciate it. And And please, if you're going to use it, if you are using it and you notice a problem or something doesn't make sense, please reach out because, like I said, this is something that Dr. Biram and I are working on and, figuring out as we go along.
I think you'll have a lot of willing testers from the chat.
Thank you very much. And I'll put my email down here as well.
All right. Well, if y'all can stand it, I've got a quick 15 slides. It's a much shorter presentation, but I think it's still an important presentation, and it is on what forms you need. And I get a lot of questions about that too. Well, if I want to get insurance, what do I do? And so I'm going to attempt to provide an overview of what that looks like in this presentation, titled "What Forms Are Needed to Buy Crop Insurance." So this will be chapter 11 in the workbook if you're following along at home. Again, you've probably seen this QR code too many times already today, but just in case you haven't been able to catch it, this is your last opportunity to scan it for the workbook and follow along with chapter 11. So what's important is establishing a production or revenue history. And I talked about that in my earlier presentation. So it's really important to establish this, especially if you're going to go with the YPRP crop insurance, because you got to prove that you have an insurable interest in the land being insured. You got to be able to show that consistently you have produced corn, you have produced soybeans, you have produced cotton, rice, wheat, whatever it may be, to the agent who will be providing the insurance to you. You need to have at least 4 years of production history to establish an APH, or the actual production history yield. This can be done with an FSA 578 acreage report. Those who are enrolled in FSA programs are probably familiar with what that form looks like. Also using settlement sheets from grain elevators. So you got to be able to tie that total production that's delivered to the grain elevator to a certain plot of land, which is going to be tied to your FSA 578. For those who are producing cotton, you got to be able to tie your GIN report to the FSA 578. So that GIN report that you get from whenever you take your cotton to the cotton gin. So you got to be able to tie total bushels, pounds, whatever it may be that's marketed to whatever your ground is on the FSA 578. And you need to have 4 years of history. Now, if you don't have history, that's fine. What will happen is you'll be assigned a T yield or a transitional yield. And those tend to be lower than what would happen on your farm, or what yields would be realized on your farm. But it's better than nothing, and that's what can help you get started to build a history. So you're totally not up the creek if you don't have a history. That is a way to build it up, but this is generally how the history is made. I do want to talk about beginning farmer and rancher rules by introducing you to my beginning farmer. This is my son, Reed. He's actually a lot bigger than this now. He's about almost 16 months old. At the time I took that picture, he was about 3 or 4 months old, so it's been about a year, but it is one of my favorite pictures of him in a set of overalls. Now, if you're a beginning farmer and rancher, what then? So you have to have 5 years or less with insurable interest in any crop or livestock to buy crop and livestock insurance. But if you're looking at whole farm, which is that fruit and vegetable insurance, really, it's for everyone. But most people who grow, apples, peaches, watermelons are going to go with the whole farm case. Anyway, you got to have 10 years of a history. You can be beginning farmer. Sorry, you can be beginning farmer for 10 years with whole farm. But if you are not going with whole farm, you can be a beginning farmer for 5 years. Now, if you qualify for beginning farmer status, and if you're able to tease through what I just butchered right there, you may use a production history of the previous producer so long as the beginning farmer rancher was involved in the production of the crop. So that's what the big idea is behind this slide. You can qualify for beginning farmer rancher if you have 5 years or less with insurable interest in any crop or livestock, or you can be a beginning farmer for 10 years with the whole farm program. And that allows you to take on the previous history, the history of the previous farmer who had the insurable interest. So that can be pretty powerful whenever you're trying to establish guarantees. Where are we at here? Okay. Establishing a revenue history. Now, this is going to be in the whole farm, micro farm case. So if you want to purchase whole farm or micro farm, you got to establish a revenue history done through the Schedule F, which Dr. Lloyd has done a fantastic job of providing coverage on. So you want to do this through a Schedule F. The number of years varies. So if you're beginning farmer or rancher, only 3 or 4 years are required. So if it's your first year to qualify as a beginning farmer or rancher, only 3 years of Schedule F are required. If it's your second year to qualify as a beginning farmer or rancher, 4 years are required. And if this is your third year, 5 years are required. And so But it is different if it's under a whole farm. But for the most part, 3 or 4 years, and then a non-beginning farmer, 5 years. Okay, so with area insurance, do you need to establish a history with area insurance? And what I'm trying to show with this GIF is no, you don't need the records. You don't need the forms. You don't need the records necessarily with area insurance. Like you don't have to have the APH, for instance, is what I'm trying to say there. Because area insurance, again, is insurance which uses guarantees based on a trigger that covers area beyond your farm or in a larger area. So think of the stacks or ECO or SCO. You don't need to establish a production and revenue history to purchase these insurances, but you still have to show that you have an insurable interest in the crop being produced. So you don't need to show the forms like the FSA 578s or settlement sheets or gen reports, but you still need to show that you do grow and produce the crop that you plan to insure with the area insurance. Now, here's an interesting question. How do I ensure that I pay the subsidized premium? You might think, well, isn't it already applied automatically? No, it is not automatically applied. But before I get into that, we have to remember all federal crop insurance premiums are actuarially fair. So the premiums collected by the insurance companies should be the same as the indemnities paid to the producers or the break-even business. All federal crop insurance producer premiums are less than the actuarially fair premium because they are subsidized. Think of it as this is a cost share program. It's not a free program by any stretch of the imagination. It is a cost share program. And the subsidy is not automatically applied. So the cost share is not automatically applied. So to pay the subsidized premium or the cheaper premium, you got to complete the 80-10-26, which is a conservation compliance form. And in the workbook, there are going to be examples of this form and other forms that I've brought up today. But be sure that your agent's filling out that 80-10-26 to get that cheaper premium. Most agents know this and will do that. But again, it just depends on the agent. Other topics. What if I already have insurance? It automatically renews. But what's important is every year you should visit with your crop insurance agent to reevaluate your coverage every single year. Just because it automatically renews doesn't mean that a farmer shouldn't take time to visit with their agent. They totally should be visiting. And especially in this year, there are some instances where even I've recommended the yield protection over revenue protection, just because I'm more concerned about price downside. Not as much price upside. So I think the prices are more likely to fall this year than they are to rise. And so if that's the case, YP has a cheaper premium and almost offers the same coverage as HPE. And so that's an instance where, depending on your farm, it might be worth it to think about maybe you should switch from YP to RP or vice versa. But always have that conversation with your agent. They know your farm, they know your data, they know your ground better than I do, for instance. Assignment of indemnity. So if an indemnity is triggered, then if it's greater than the premium paid, then it's sent to the insured. Okay, so Ron brought up the phrase the mailbox money or something that you automatically get in the mailbox or in your direct deposit. But if the indemnity does not trigger, or that indemnity is less than the producer premium, then the farmer will have to pay a premium. But we have this little form called the assignment of indemnity, and it assigns any indemnity net of premium sent to your financial institution to which you're getting your loan from. So that's what I have in this GIF here is, it's like you think that you're going to get that indemnity check in the mail, but maybe you got to pay off that, you got to pay off that new planter. You got to pay that new tractor. Maybe you got to pay for the seed, and you got to use that indemnity to pay for seed. And so that's what I'm trying to show here is like, man, you might get that money that could help you pay for stuff, but maybe your lender needs that money worse than you do, and they're going to be the ones that get it. And the assignment of indemnity, I think, is a great form. It's kind of like a form of self-accountability that you will pay your loan obligations before paying anything else. So my last slide here. Wasn't that fast? What if there's no insurance offering? Well, you can offer a written agreement. I've heard of people doing this for pecans or for wheat, which will be hayed. So for those unique practices, those unique crops to a county that maybe there's no current insurance offering for, you can still offer up the written agreement. You have to just prove that you can grow that crop there and that you have grown that crop there and prove it to RMA, and then they will end up helping you to write a policy. And there's this thing called there are these things called the high risk zones, which if you're in a floodplain, for instance, your rates are going to be higher than if they're not. So in some instances, if there's a high enough premium increase, you can talk and work with RMA to get that rate lowered. So hopefully your agent would be involved in that process. But if not, you still can be involved in that to lower your rate. RMA ultimately assesses your situation and determines if your rate can be lowered through your farm level loss history, for your proximity to high risk zone, for your proximity to other risks that are not normal or not expected. And then you can have your rate adjusted to better, more accurately reflect your risk. And that's all I've got. I just want to go in there and just be sure that we were all exposed to the forms that are needed. And again, bring attention to the appendix in the back of the workbook, which will have all of those forms just to give you an idea as you're getting ready to buy insurance, that's what you need to get it done. And so with that, I will turn it back over to our lovely host today.
All right. Well, what encyclopedic knowledge here that you've provided us with, and with that, I'm not seeing any questions, but we'll just give people a moment or two to pause and see if there are any questions. Just a note too, I did put a link in the chat in case you missed the QR code or in case you had some issues. Some folks aren't QR code fans, so just want to make sure that everybody gets that workbook, because it is an excellent tool, excellent resource that both of you I know worked very hard on. So with that, we'll give people a moment or two to breathe here. But from either of you, while people are thinking, any kind of final words on, just from your experience with crop insurance? We have people with all different skill levels that are on our session today. Any kind of little things in particular that people should remember, or I think there's a little fear sometimes with this, and lots of forms, lots of language to get through. What's your best advice for folks that are maybe just getting started and down this path?
I think perspective is so important, really, in all of life, but in particular with crop insurance. Having the perspective of its risk management, and you don't want it to pay, really. You really don't want the insurance to pay, right? Because if you think about it from your auto insurance, your car insurance, you don't want to have to collect an indemnity, because that means you got to an accident or something. At minimum, you got to a fender bender, or maybe it got totaled. But either way, you don't want that to happen, whether if it's a shallow loss or if it's a deep loss. That's bad news. Same with your house. You don't want to have to collect that indemnity to build a new house. Yeah, it's nice whenever it's there, don't get me wrong, but like, you don't want to have to rebuild a house or relocate, or it takes time to rebuild a house. It takes time to find a house. And so think of it that way. Ultimately, crop insurance is risk management, and we don't want it to become an income transfer by any stretch of the imagination. And so I think just having some healthy perspective as you're going into the process always helps, because you're not always going to get an indemnity.
That's an excellent point. I think so many of us think about, oh, all of this money I'm putting into this crop insurance and I never get anything out of it. Well, you really don't want to get anything out of it, right? Just like, pointing out, you don't want to get in a car accident. You want your house to be burned down or taken out by a tornado. So it's like, we similarly shouldn't want bad things to be happening with our crops or livestock. And so very good point. Very good. Ryan, did you have something else to add?
No, I just wanted to echo Hunter. Really that's really the big thing of what, when we present this, and that perspective is understanding that, this is just a way to have some sort of risk protection, underlying. And I did not come up with the way to say this. It may have been Hunter, the one who said this first that I heard it, but what you're doing is essentially just guaranteeing yourself the ability to farm next year. And that's really important. A lot of our farmers, that's what they want to do. They want to farm. And so you get insurance that, even if it doesn't pay, well, that's great. You're doing a great job. But if it does, you've now at least guaranteed yourself one more year. And so that's a perspective that I like to take when looking at this.
Great, great. Well, we certainly appreciate all of your knowledge and your expertise that you've shared with us today. Just wanted to do a little commercial. Tomorrow we're going to have tomorrow evening, a focused webinar on specialty crop insurance. And so we invite everyone to attend that. And then also we are offering, and I just put in the chat, there is a link to registration. We are doing a 4-part free course on, it will be live virtual, as well as we will be recording it, but it will be on specialty crop insurance. And so we will be covering a number of topics. We will be covering record keeping and crop insurance, how that goes hand in hand. We'll also have a budgeting as a risk management tool for ag producers, both partial and enterprise budget, and how that can roll into crop insurance. And then we're going to focus on specialty crop insurance, whole farm and microinsurance. And then we will have a session on marketing risks for specialty crops and a course wrap up. So that will be happening in March. And as I said, it will be free. And that's part of this whole project that we're working on, and invite you to participate in that. And also, we will be starting to post our own podcasts. You were talking about podcasts. There's a new podcast series in Plain Talk coming out from Annie's project as well. So lots of opportunities, folks, to learn about crop insurance, both from our gentleman from University of Arkansas and from Annie's project. And we're all happy to work together to provide you with this good information, useful information, hopefully help you manage risk better in your operations. So with that, I don't see any questions, so we'll say goodbye for now. And again, thank you so much, everyone, for attending. And thank you so much, Hunter and Ryan, for your excellent presentations.